I recently put out a question on Twitter asking how much you would have to invest right now to be able to live off dividends forever, and I got answers ranging from as high as $10 million to the lowest being $1 million. And while the reality is that it could be difficult to live off dividends forever on $1 million, with the right strategy, it is possible. While most think we simply need to invest in high-yielding dividend stocks, there is much more that we need to consider than just maximizing immediate dividend income. We need to consider things like inflation, the quality of the businesses we hold, diversification, the threat of dividend cuts which could potentially be devastating to a retirement portfolio, and ideally we'd like to be able to grow our income every single year as well. So in this video, we're going to be building an example portfolio showing how we could potentially live off dividends forever with $1 million. Now, in order to live off dividends forever with $1 million, we need to take some steps to set up our goals. First off, let's figure out what our cost of living is. While cost of living varies quite a bit depending on your location, in most places in the US, it is generally accepted that you can live off $50,000 a year as of right now. So our year one goal for our portfolio is to generate at least $50,000. But here's where things start to get tricky. If our goal is to live off dividends forever, we need those dividend payments to increase over time, and this is due to inflation. For example, in year one, if our cost of living is around $50,000 and inflation is around the historic average of around 2.5%, in year two, our cost of living will bump all the way up to $51,250. That's an increase of $1,250. And by year 10, we can see our cost of living will be sitting at $62,443. So it is absolutely imperative that our dividend payments increase over time and that it also outpaces the rate of inflation. It's also imperative that we properly diversify our portfolio with multiple holdings. Now, we also need to make sure we focus on the quality of the business to avoid dividend cuts. And for example, it may be easy to feel like we want to invest into a popular company like 3M because of the nice starting dividend yield sitting at about 6.59%. But again, if we look at the dividend growth rate for this company, we can see over a 3-year time period it was below 1% and over a 5-year time period below 2%, meaning it does not outpace the historic average rate of inflation, so we could not live off dividends forever. So let's go ahead and start building out our portfolio. And remember, we need it to generate over $50,000 a year, and we want our weighted 5-year average dividend growth rate to be above the rate of inflation, meaning we need it to be above 2.5%. So our first position we're going to add to our portfolio is going to be the Dividend Growth ETF SCHD. We're going to allocate 25% of our portfolio to it, meaning $250,000. Now, this fund has a yield of around 3.5% right now, meaning it would generate us around $8,750, and it has a high 5-year dividend growth rate of around 13.05%. So that's a decent boost to our dividend income, but more importantly, a very nice boost to our weighted 5-year dividend growth rate. We can see historically this fund has done very well, and over the past 10 years is up over 113%, not including its dividend payouts. And when we look at the dividend history for this fund, we see a phenomenal history of growing those dividend payments every single year. We can see the 3, 5, and 10-year dividend growth rates look phenomenal. And because this is a dividend growth ETF, we get exposure to 104 different companies across 10 different sectors. So SCHD makes for a great base for our portfolio. Now, the problem is if we're going to generate $50,000 a year initially, we need our starting yield to be above 5%, and SCHD falls below that threshold. So we need a few higher yielding investments. And one of those investments I think I would use for my portfolio would be Realty Income, stock ticker O. I would allocate around 15% of my portfolio to this, meaning $150,000. And as of right now, Realty Income has a starting yield sitting at about 5.88%, meaning it would generate around $8,820 a year in dividend income, and it has a 5-year dividend growth rate of around 3.66%. This means we've already used 40% of our capital, and we're currently generating around $17,570 a year with a weighted 5-year dividend growth rate of around 3.81%. Here's what I really like about Realty Income. If I jump over to the income statement and scroll down, we want to see if they are growing their adjusted funds from operations per share. And if we scroll down just a little bit further, we can see right here adjusted FFO per share over the past decade. And if we look at this charted out, we can see a decent history of growth, and that growth is projected to continue, meaning it's likely they'll be able to sustain those high dividend payments and even grow those dividend payments over time. Now, we still need our starting dividend yield to be a little bit higher, so in this scenario, I would also add Vici to my portfolio. Just like Realty Income, I would allocate around 15% to Vici, meaning $150,000. Now, the starting yield is a little bit lower than Realty Income, but it's still very nice at 5.62%, meaning it would generate us over $8,430 a year in dividend income. Now, the 5-year dividend growth rate for Vici Properties is very nice, sitting a little over 10%. So if we jump over to Seeking Alpha, which you can get a link to in the description, we can see over the past year they are down around 11.87%, but I think they have plenty of potential to grow in the future. And like I said, if we jump over to the dividend tab and click on dividend growth and scroll down again, we can see 3-year dividend growth 8.66% and 5-year dividend growth of around 10.05%. Now, it may not be that high moving forward, but I do expect decent dividend growth rates from this company in the future. But here's what's also beautiful about this company. If we look at the forward-looking AFFO growth, it's projected to be around 7.36%, which is plenty enough healthy to be a part of our personal portfolio. So now we've used 55% of our capital, we're currently yielding around 4.73%, and it's generating around $26,000 a year in dividend income with a 5-year dividend growth rate of 5.32%. Now, the next company that I would allocate capital to is going to be EPD. This is an oil company. I would allocate around 13% of my portfolio to it, and it currently has a yield of around 7.56%. So this is one of our higher yielding positions, and this would generate over $9,828 a year in dividend income. Now, the 5-year dividend growth rate is also the lowest that we've seen at around 3.05%. Now, over the past year, this company is up around 6.43%, but keep in mind, most of the returns you see from this company will be in the form of dividends. Now, if we jump over to the dividend tab, let's look at the dividend safety for this company. We can see the payout ratio as a result of earnings sitting at around 80%, so that is pretty high, but as a result of their cash flow, it's sitting at around 50 to 55% forward looking. So yes, this company does use a lot of their capital to pay out dividends, but as of right now, it does look like that is sustainable. Now, the 5th company that I would add is probably one you're familiar with, and that is T. Rowe Price. I would allocate a small amount of my capital, only around 6% to T. Rowe. We can see they have a starting yield sitting at about 4.56%. Income would be around $2,736, but their 5-year dividend growth rate is very high, sitting at about 11.75%. Now, like Vici Properties, I don't think it will be that high moving forward in the future, but I still think it will have solid dividend growth moving forward. Now, over the past year, this company's down around 3.44%, and over the past 10 years, it's only around 40%, but we have to keep a few things in mind. Again, a lot of their returns come in the form of dividends, and in this particular scenario, we're more focused on growing dividends and dividend sustainability. And so if we jump over to the dividend tab and look at the dividend safety for this company, we can see the payout ratio as a result of earnings sitting anywhere from around 62 to 65%, and the cash flow payout ratio sitting at about 45.43%. So again, it does look like those dividend payments are sustainable as of right now. So now at this point, we've used around 74% of our capital. The yield for our portfolio is sitting at about 5.21%, meaning it's generating around $38,564 a year in income and a weighted 5-year dividend growth rate of 6.42%. Now, we still have around 26% of our capital to allocate, so let's go ahead and move forward. And the next position that I would add to this portfolio is going to be, again, one you're probably familiar with, and that is ABBV AbbVie. Again, I would allocate around 6% of my portfolio to AbbVie. They currently have a starting dividend yield sitting at about 3.5%, meaning they would generate around $2,100 a year in dividends. Now, their 5-year dividend growth rate is sitting at about 8.68%, and we can see now our portfolio is generating over $40,000 a year after allocating 80% of our capital. Now, AbbVie has seen really solid share price appreciation over the past year and over the past decade. Over the past year, they're up around 16.28%, and over the past 10 years, up around 247%, and they have a phenomenal dividend history. We can see the dividend growth rates have been very solid from this company over the past decade, and if we look at the dividend safety for this company again, these look to be somewhat healthy for a company with high dividend payouts. Cash flow payout ratios are in a healthy range, and dividend payout ratios as a result of earnings is in a healthy range as well. Now, the 7th company that I'm going to add to this portfolio is one of the highest yielding ones in this particular portfolio, and that is going to be MO Altria Group. Again, we're going to allocate around 6% of our capital to this position, and they have a very high starting dividend yield sitting at 9.76%, meaning they would generate over $5,856 a year in dividend income, and they also have some dividend growth despite their high starting dividend yield. Now, oftentimes people are concerned with the sustainability of the dividend payouts for this company, but if we jump over to the dividend safety tab and look at their cash flow payout ratios, it appears they're in a decent place. Their cash flow payout ratio sitting at about 79.7%. Now, this is pretty high because it only leaves around 20% of their cash flow left to do things like reinvest back into the business, but their management team has stated that they are targeting an 80% cash flow payout ratio, so they're actually exactly where their management team wants them. Now, if we look back at our portfolio, we can see we've now used 86% of our capital, and we're generating $46,520 a year in dividends with a weighted 5-year dividend growth rate of 7.24%. So I want to add 3 more positions to this portfolio, and this next one is going to be one of the most popular ones among dividend investors, and that is Coca-Cola, stock ticker KO. I would allocate around 5% to this position. Now, this company only yields around 3.27% and also has a low 5-year dividend growth rate, but this company pays some of the most predictable and stable dividend payments out there, and they've been paying them out for over 50 consecutive years. For someone looking to live off dividends, obviously you want to be confident that those dividend payments are sustainable, and Coca-Cola is exactly that. Now, here on Seeking Alpha, we can see over the past year, they're only up around 2.41%, but if we look at the growth, we can see the growth rate projections moving forward for this company are somewhat low, but they are positive and it's pretty stable. In fact, if we look at the earnings per share forward-looking long-term growth over a 3 to 5 year time period, it's projected to be at about 6.21%, meaning that those dividend growth rates should be sustainable as well. Now, the 9th company we'll add to our portfolio again is a popular one, and that is Johnson & Johnson, stock ticker J&J. I would allocate around 5% of my portfolio to them, and with a starting yield of around 3.04%, they would generate around $1,520 a year in dividend income, and they have a 5-year dividend growth rate of 5.75%. So now if we look at where we're at, we've used 96% of our capital, we have a starting yield of around 5.17%, we're generating $49,675 a year in dividend income with a pretty solid 5-year dividend growth rate of 7.7%. Now, Johnson & Johnson is another one of those companies that have had a pretty good decade. They're up around 72.25%, not including dividends, but the dividend history is even more impressive. They've been increasing dividend payments for 61 consecutive years. Again, in this scenario, we obviously want predictable and stable dividends, and Johnson & Johnson provides that. We can see in 2014, they were paying out 66 cents per share, but now in 2024, they're paying out $1.19 per share every single quarter. And just like Coca-Cola, when we look at that earnings per share forward-looking long-term growth rate, again, it's low, but it is high enough for them to continue to increase those dividend payments over time. So now we're in a situation where we have 4% of our capital left, and we still need to boost our dividend income just a little bit. So now I'm going to pick a company that is more popular among high-yield dividend investors, and that is Main, stock ticker MAIN. They have a starting yield sitting at about 6.42%, meaning they would generate around $2,568 and have a 5-year dividend growth rate of 3.78%. Now, this company operates in the asset management industry, which I'm not usually a fan of, but they have done fairly well. I will give that to them. If we look at the dividend history for this company and scroll out, we can see not only do they pay steady dividends, but every now and then they also pay out special dividends, which would be a nice boost to the portfolio. So now we've allocated 100% of our capital. We can see our portfolio has a yield of around 5.22%, and it's generating $52,243 a year and has a weighted 5-year dividend growth rate sitting at 7.85%. So let's go ahead and assess if we'll be able to live off dividends forever in the scenario with $1 million. If we scroll down, we can see in year 1, again, our cost of living at $50,000, but our income is $52,243, meaning we would be able to live off dividends with over $2,243 left over. And as we scroll down and look at the years, we can see the difference is increasing because our average dividend growth rate was higher than the average rate of inflation. And if we look at this charted out, we can see the red bar is going to be our income and the blue bar is going to be our cost of living. So in this particular scenario, it looks like we could live off dividends forever with $1 million. Now, I think part of the reality is some of these companies have very nice 5-year dividend growth rates, but it might not be that high moving forward in the future. So let's go ahead and manually adjust this and say we're only going to have a weighted 5-year dividend growth rate in the future of 4%. I'll hit enter and let's see how this affects our scenario. If we look at this charted out, we can see we can still live off dividends indefinitely, but the difference will not be as large as we move forward. But we can see by year 10, our portfolio could be generating over $74,350 a year, while our cost of living is sitting at about $62,443. This would mean we'd have a difference of almost $12,000 that we could use to spend on other things, or we could also be using this difference to reinvest back into our portfolio to further strengthen our portfolio. In fact, if we scroll down even further, we can see that by year 20, this portfolio could be generating over $110,000, while our cost of living is around $80,000. That would be a difference of around $30,136. Something else to consider is that living off dividend payments can actually be extremely tax efficient, especially if you have no other sources of income. So while living off dividends forever with $1 million is clearly not easy, with the right strategy in place, it can be possible. It's important to look for things like a combination of solid starting dividend yield, decent dividend growth, solid diversity, and a good business model. Now, if you think living off dividends is not in reach for you, then I suggest you check out this video, which I'll have linked in the description down below. But go ahead and let me know in the comments down below what you think you'll have to do to be able to live off dividends, and if there's anything in this portfolio you would change. But with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.